Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, March 15th, 2022. Welcome back to the podcast, George.
Hi, John. Good to be back.
Always good to have you. So for our listeners, as background, we are recording this episode on the eve of the March FOMC meeting. So George, before we jump into the FOMC preview, why don't we reflect back on price action post the last FOMC meeting? And there's been a ton going on, over the last weeks and months. So just, kind of big drivers, maybe year to date.
Yeah, sure. And I think really looking back to the January FOMC meeting and comparing where we are basically early week before the Fed makes its decision is a good kind of starting point to think about how much markets have already moved. So for example, if you look at the 2s-10s curve, it's basically flattened about 40 bips intra-meeting. The 2-year, largely driven by a massive sell-off in the 2-year, which was on the back of another sell-off that happened between December and January. So in total, these last two FOMC meetings, the 2-year has really bore the brunt of the move. And in many ways, at least in my opinion, it's started to feel like it's gone a little bit too far. If you look at the credit markets, for example, credit has widened nearly 50 basis points. I mean, that's a really big move in IG spreads intra-meeting. The stocks have been perpetually on a downslide, or it feels that way since the start of the year. But in reality, between the meetings, it's actually we're kind of been chopping around. Stocks had a low also early on in the year, made an attempt to kind of bounce back, and then have come back down to the lows. Short covering rallies aside, so we've seen a lot of volatility. We've seen a massive flattening of the curve. We've seen largely driven by the front end a rise in rates. But we were also now at a point where the 10-year is reflirting and has broken back above the 2% level. And as I've been writing about and flagging in various mediums, the 220-ish, 215, 220-ish level, which is basically where rates are kind of settling in here before the Fed meeting, is a really critical level for the long-term bond bull run, which has been in place for 30, 40 years. And so this is a really pivotal time. Obviously, we also had the invasion of Ukraine by Russia and the commensurate move in commodity markets, which led to a lot of dysfunction as well and a lot of volatility. So there's been a number of factors, not a short list, and I think we're still picking up the pieces and trying to figure out how that's going to impact the macro environment and global economies in general. But the sort of fall and the sharp moves, both in rates, credit, stocks, not so much, but definitely in the pure fixed income space, this is one of the biggest bear market starts of the year. And I think it really kind of sets up the Fed for some challenges of how to thread this right when they meet tomorrow and actually deliver their views.
Yeah, that's well said. I mean, you really so much has changed, since the last FOMC meeting, and I would kind of argue all of it makes the Fed's job harder. So,
100%.
yeah. So, but hey, you just recently published your FOMC preview. Why don't you take our listeners through your views? Just generally, what should they expect from the Fed at tomorrow's meeting?
So tomorrow is another quarterly FOMC, which is the meetings where they will give us, in addition to the statement on their views for the economy and monetary conditions, they're also going to give us an update on their forecast projections and the summary of economic projections, the SEP, where you'll get interest rate updates, inflation updates from the Fed, growth updates, unemployment rate updates. And I think that's going to be fascinating to watch because since then, inflation has not stopped. It's continued to rise higher, and one could argue, and I think it's not really going out on a limb here, given the moves in oil. Even if now oil has come back down from the recent highs, I think the damage has been done to inflation, at least in the first half of the year. And it's going to be interesting to see how the Fed weaves that into their forecast, because just like every other forecaster out there, everyone's been marking to market and not really getting ahead of like this inflation impulse. And so, it's hard to calibrate, and we all understand that, but it's going to be really interesting to see how they characterize the outlook for inflation after these, sort of disruptions. And then you have, the rates updates, the dots updates, where the market's now pricing in basically 7 hikes. So if you take it at a 25 bip increment, that's basically a hike at every meeting until the end of the year. Um, I think the market has kind of moved down to expecting 25 at the March FOMC, which is also our view. But the market has basically priced in the path for the Fed. And so, do they actually meet the market? Do they come in under the market? That's going to be also very interesting, because that has signaling power. And so, I think they're not going to fully put in 7 hikes, because they've already skipped the January meeting. So there's 8 hikes, 8 meetings per year. So if they do 7, that would be, I think, a little bit too much. The one thing to also think about, which is more of an upside risk or downside risk, depending on where you're looking at it from, if our view is not right, and actually the Fed puts in more than 7 hikes, it's not as if they're going to hike intra-meeting, but that might be a signal that they're going to do a 50. So it's really going to be really important to watch the mechanism of the dots to see is the Fed market to market, or they're going to go beyond it, and then what they signal on their inflation outlook, because it's clearly not coming back down anytime soon, and it's not going to be in line with their last projections. And then, of course, we have the press conference, which, in the past we've seen where the official communications, like the statement and the forecasts, are a little bit dovish, but then Chair Powell starts speaking and starts to kind of get more on the hawkish side. It's going to be interesting to see if that's the same case this time around. Again, this is most likely going to be the start of the hiking cycle. That in and of itself is hawkish, but yet it doesn't feel that hawkish, considering that we've priced in so many hikes already. So I'm not sure if it's going to be an anticlimactic event, and it rarely is. We always see the Fed deliver some sort of new information. And then I guess the really big one, which is something I've been harping on for nearly 4 or 5 months now, which is, do they or don't they, when will they launch or signal that the quantitative tightening, the shrinking of the balance sheet is going to begin? I think there's a risk for it tomorrow. I still think that they probably want to kind of gingerly put us into a hiking cycle first, and then take care of the balance sheet in either May or June meeting. But they've been accelerating a lot of their policy initiatives. So if they were to raise 25 basis points and do the quantitative tightening at the same time, that would be pretty hawkish. And I think that the overall rates complex would sell off, probably with the bear steepening type format, which maybe is what the market's starting to kind of sniff out here. And equity markets would really come under pressure, as well as credit. So I think those are the risks. I think my base case still is 25 and QT later, but it's becoming very binary, and it's really a close call.
Yeah, and central bankers can still very much surprise, as evidenced by the ECB as recently as last week. So, so let's see here. So I guess you lay out 3 scenarios, for how the Fed will react tomorrow, from dovish to hawkish. So take us through those 3 scenarios, as well as market reaction.
So I'm kind of evenly split between dovish versus hawkish, and I think that they're going to try to thread the needle and be as neutral as possible, because they're starting, which is going to be an important process of tightening monetary conditions after a period of high inflation and excess liquidity. I do believe that's going to be their preference, but I mean, there might be some information that we learned that sounds dovish, some information that we're going to learn that it sounds hawkish. If we get the more neutral outcome to slightly dovish, then of course you're going to get a relief rally in pretty much every asset class. And I think the curve steepens more from a bull format, and we don't get like a further sell-off in twos, and maybe we mark the highs in yields at the first Fed hike, which is not necessarily unusual. If I'm wrong, and my bias is towards neutral and dovish, but if they are further hawkish, it's the release of the quantitative tightening which will really tip us over. And I think at that point, it's more the bear steepening, and spread widening that I'd be more concerned about in that sort of outcome.
Yeah, and I think I couldn't agree with you more. I think the market would have trouble kind of digesting that. But we will know more very soon. And for more ahead of the FOMC meeting, I would really encourage our listeners to check out George's published March FOMC preview. And again, if you are not receiving George's strategy reports directly, please get in contact with George or myself, and we'll remedy that very quickly. George, thanks again for coming on the podcast. Great stuff as always.
Thank you, John. Appreciate it.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.